Mack, and I'm with First. Oh, there we go. I'm with First American Exchange, and we are a 1031 qualified intermediary. So welcome to all of you on Zoom as well. If you have any questions, just type them in the question box, and I'll try to manage that as well as while I'm talking here. So today we're going to talk about 1031 exchanges. How many of you guys are aware of what those are, or have never done one, or have done one? Is everybody kind of aware of what they are? No, we've got a couple of people who aren't. Okay, great. So, so I'm going to go through what's called the basics and beyond. I think the most important thing is to get out of this meeting today, honestly, is my name and phone number and email address. So make sure you write that down. I'm going to follow up with you guys after the class via email and send you some great tools as far as having stuff available to you that you can give to clients if they should ask you if they're interested in a 1031 exchange. But what I find is that it's interesting. I love teaching 1031 classes. This is what I spend a lot of my time doing, because a lot of people out in the marketplace, including realtors, don't know what it is. And it's such a great and effective tool for anyone who owns investment property or property that they use in the sale and for productive use of their business. So I like to tell real estate agents that, you know, one of the first things that you should be asking is when you meet with a client, is this investment property? And if they say, yes, it is, the second question is, do you want to do a 1031 exchange? And 9 times out of 10, you're probably going to hear from the investor, what is that? Okay. There's so many people who don't know what it is. So important for you to know a little bit about it. But most importantly, if they want to do a 1031 exchange, you want to just tell them, well, it's a way to defer your capital gains taxes and not have to pay capital gains if you're going to go and invest in more property. And then call Trish. She can help you work through the process. So let's talk about what, so this is what we're going to talk about today. What is a 1031 exchange? What are the requirements for one? How does it work? How does my client set one up? And why do you and your client care about it? The worst call that I get is usually from an investor who will call me and say, I got 2 already this week. They will call me and say, hey, guess what? I just sold my property. I've heard about you. I heard you can help me with the 1031 exchange. And I closed last week. And I want to do a 1031 exchange. And my answer is, I'm so sorry, but the 1031 code is no longer, you're no longer eligible for it, because you have to engage with a qualified intermediary, which is someone like myself, in order to facilitate the exchange and hold the money prior to closing. So again, why is it important for real estate agents to know about this so your client doesn't close and they don't come back to you and say, because the other thing I get from this, why did my real estate agent tell me this? Yesterday it was, why did my real estate attorney tell me about this? So I've had, why did my title company tell me? So it's so important for you guys to know about this tool, okay? So what a 1031 tax exchange, what the code says is that it allows the investor to, they're able to defer capital gains taxes as long as the property that they're selling and the property that they're buying, that they're holding that for long-term investment purposes or for the trade or use in a business, okay? So perhaps they have an optical shop that they own and it's a freestanding building, they own an optical business in there. They could actually do a 1031 exchange with the real estate involved in that business, as long as if they were selling it, okay? And you want to be exchanging for like-kind property. And we're going to get into what like-kind really means, because there's a lot of misconceptions about that. But generally speaking, it's really just fee simple interest, fee simple property, okay? But again, it must be used for investment purposes or used in the productive use of their business. So I get a question a lot of times too, where folks will be like, oh, well, I'm selling an investment property, but I want to move down to Florida and I want to buy a primary residence. Can they do that? No, they can't, okay? So let's talk about a little bit of the history of 1031s, because they have been around for over 100 years. The first legislation came out in 1921, and which allowed tax deferral. And basically that came into play because people were just swapping properties, farmland for farmland. And there was no gain really being recognized, no money gain. So they were like, why should there be any tax implications? And the government said, okay, sure, we'll allow you to do this simultaneous exchange and you're just swapping property. Well, along comes 1979, the Starkers end up doing an exchange with another group, but the other group doesn't really have any property that they want. So they decide to have them hold their proceeds, and why they go out in marketplace and find something. Well, they finally found something in 2 years, and the other group used those funds to pay for it. So they never touched the money. And they thought they had a legal exchange. Well, the IRS came back and said, no, it's not a legal exchange. And they took it to court, and the court said, yeah, it is a legal exchange. It's under what, the general rules are for the regulation, which was that you can't touch the money. So that's when these 45-day and 180-day deadlines came into play, and regulations with safe harbor rules. That's where we have these new rules that now limit the times that you have to follow with doing a 1031 exchange. Okay. So here's some exchange terminology for those of you who are fairly new to what it is. A 1031 tax deferred exchange, you may hear it called a starter exchange. You may hear it called a delayed exchange, deferred exchange. They're all the same, or like kind exchange. Those are all the same thing. Okay, it's really what we're going to talk about today. The exchanger is the taxpayer, and it's the person who's selling the property. The relinquished property is the property that's being sold, and the replacement property or properties is the properties that are being bought. The qualified intermediary is someone such as myself. And like I said, I'm with First American Exchange. We are a very large company. We're a national company. You might be familiar with First American Title. We are a division of that. However, I have nothing to do with title whatsoever. So I am only a qualified intermediary, and I don't interface with the title folks. So I don't have anything to do with that. Simultaneous exchange is where you're swapping properties at the same time, and a delayed exchange is what we're going to spend time talking about today. Does anybody have any questions so far? I don't know how to manipulate this. I'll have to figure that out. Okay. So here's reasons why someone would want to do a 1031 exchange. They have built up in gain. So perhaps they bought something 5 years ago, and obviously we know with the market right now, you could have bought an industrial building for $500,000 and it's now worth $1 million. They go to sell it, they've got $500,000 of gain, and they want to defer those taxes, but they also want to go out and buy more property. Consolidating several properties into one property. Perhaps someone has several rental houses, and now they want to go buy an apartment complex or a 4-unit or a 3-unit, something like that. Diversification can be another reason for doing a 1031 exchange. Getting out of one market, moving into another sector. Relocation, obviously we're seeing a lot of that here in Florida right now. Not only are you seeing people coming down to move their primary residences, but they're also selling their investment property and coming in this area as well. Increase in cash flow. I'm doing a lot of land deals right now. So where families have gone for land for a long time, and now they're selling it to developers, and they want to, they've got a lot of gains. So now they want to create some cash flow. So they want to buy approved property so they can get some income coming in on that property. Management headaches can be another reason, as well as implementing estate planning. So at the end of the day, what is the client really trying to accomplish? They're really trying to accomplish having more money for reinvestment because they're deferring their capital gains. So let's look at what that looks like. So in order to have a fully deferred exchange, it's really important. You have to do 3 things, okay? And well, there's a couple other rules, but you want to make sure you're doing these things. And there's such a huge misconception out there. It's almost a conversation I have every day. Everyone thinks that when you do a 1031 exchange, that all you have to do is reinvest the proceeds. Not true, okay? To have a fully tax deferred exchange. So if you want to be fully tax deferred, you want to buy something that is equal or greater in value to what you're selling, okay? You want to have equal or greater in value in your equity. And if you have any debt in the property that you're selling, you have to replace that debt with new debt in the property that you're buying, or come to the table with cash outside of the transaction. Okay, so it's really kind of an equal kind of thing. So looking at this, I don't know,
it could be less, but then it's not fully taxed.
Right. Yes, it could be less. And then you'll have what's called boot. And we're going to talk about the different kinds of boot. So in this particular scenario, you have a relinquished property that's being sold at $2 million. We're assuming debt of $1 million and $1 million of equity. Well, if you go out and buy another property for $2.5 million, you're buying equal or greater in value. You're replacing debt of 1.5. So you've got equal or greater in debt and $1 million in equity. So you'll have no tax event, which is actually what's called no boot. Okay. So that's fully deferred. You don't have to be fully deferred, but that's what it looks like if you are. Okay. So let's look at something like this transaction. let's say that you have a sales price of $1.8 million. Okay, your original purchase price on this property was $800,000. So you've got $1 million of gain. If you were not to do a 1031 exchange, you're going to be paying somewhere between 15 and 20% for capital gains tax, and that depends on your income tax bracket and your income, I should say. State tax, which we don't hear out here in Florida, but if you're in California, it's 14.6%. So that can be a hefty number. And then you have Medicare tax, which is also just another really capital gains tax. And then there's this thing called recapture of depreciation, okay, which is 25%. So that alone could be a reason for someone to do a 1031 exchange. Perhaps they've held on to a building for a long time, they fully depreciated it, and now they want to take 25% back on that depreciation amount, depending on the price of that property. So that could be a big number and a reason to do a 1031 exchange. Again, I don't know why my slides are wonky like this, but anyway, they're supposed to be straight columns. So again, this is just what that looks like on paper. We're going to assume that we have appreciation of $1 million, and we're going to assume that we have a 15% tax bracket, and we're going to assume $100,000 of depreciation. So if we were to take those assumptions, that means you would pay the government $175,000 in taxes on these transactions, versus doing a 1031 exchange where you could defer that $175,000 and give you more money for reinvestment. So definitely a good tool to keep the economy rolling and to keep your investments rolling. So let's talk about boot, okay? Boot is something that is solely not like kind, okay? And it can be generated a few different ways, okay? So oftentimes we'll see cash boot. This is what happens when somebody will, I'll just give you an example. Like I have a guy right now who's doing a $3 million deal. He's held onto this property for 27 years. I think he bought it for like 180,000, and it's now he's selling it for 3 million. Well, he wants to take out, he's an older gentleman, he wants to take out about $300,000 in cash. And then he said, can I do that? And I said, absolutely, you can do that. It will be taxable, and you have to take it out at the time of closing, okay? So we always will talk to our clients about making sure if they want any money out, they take it out prior to us starting the exchange. Because once we've started the exchange, you can't take funds out. So that would be cash boot. Mortgage boot would be something if you didn't replace the mortgage. So let's say you had, $100,000 of mortgage on your property that you're selling, and now you either don't want to put any debt on it. If you don't come to the table with cash, then you're going to have some sort of mortgage boot there, and there'll be a tax event. Same thing with buying down. So perhaps you're selling something for 500,000, you go and buy something for 400,000, that $100,000 difference, there's gonna be some boot on that as well, tax events. And some closing costs can create boot as well, okay? Typically the closing costs, your normal closing costs and your commissions can be paid out of the proceeds and will not be considered boot. Things that would maybe be considered boot would be, additional loan fees, especially now that interest rates are going up, you might see people buying down. So those kind of things would be considered boot and could be taxable. So really important to make sure that they're talking with their tax advisor or talking with us to make sure that they know, we can tell them what's boot and what's not boot. So in commercial property, security deposits, different things like that. So there are two timeframes that run from that surround this entire 1031 transaction, okay? And they both start from the day after closing of the relinquished property, so the property that you're selling, okay? There's the 45-day deadline, and then there's a 180-day deadline. You have 45 days in which to identify replacement property from the closing date of the sale, okay? And we're going to talk about what identification really means. And then you have 180 days from the closing date in which to acquire or close on one or more of those properties that you have identified. The actual rule is a really little bit more tricky. What it really says is that you have 180 days from closing to acquire replacement property or the due date of excluding extensions for the taxpayer's tax return. So this will only come into play if someone's doing a transaction at the end of the year. So late November, December. That would happen because if they sell something, if they want to take advantage of their whole 180 days, that 180 days is going to be past April 15th, right? So they would want to file a tax extension in order to make sure they take care of that. They get the full advantage of the 180 days. Now, that's not something you guys really need to know, because if you're working with a esteemed qualified intermediary, we are notifying all of our clients about that all the time and making sure that they're following the rules, regulations. Okay.
It has to close in that 180 days, right? Not be a contract.
Right.
Not new construction or
Right,
anything like that.
right. So I heard you guys when I walked in here talking about new sale, new builds. So that's an issue right now. A lot of people are wanting to buy new builds, especially coming out of their 1031s and wanting to buy those properties, and it's great. But I always try to make sure everyone understands that those 45 days and that 180-day timeline, there is no exception to that. Okay. And so we've got some supply chain issues, we've got building issues, we've got cost issues. And so construction is generally being pushed back quite often. So, if someone's only identifying that one new build, I'm like, be careful, because if they come back to you, and at the closing, they push the closing out past that 180 days, you've got a failed exchange. So, and it doesn't matter if you've paid deposits, and it doesn't matter if you've identified it. Okay. So this is just a quick visual of what the timeframes look like. Again, day 0 is the closing of the relinquished property. Day 1 is the day after closing. Day 45 at midnight is when you have to identify your replacement property. And day 180 is when you must close on one or more of those properties that you've identified, or the earlier of when the tax return is due. Keep in mind that there are no extensions. And even if the deadline is a Saturday, Sunday, or a legal holiday, doesn't matter. Okay.
I have seen an exception. That's why we're doing a 1033 exchange, and they could not identify it. The whole family had to agree on it. It was just a pain. So they missed their date, and then I went and looked, and because of Hurricane Irma, I was like, "You have X amount of time." They still never did.
Really? Yeah. So the only time you will see extensions, they'll be listed on the IRS website on irs.gov. And they will usually do some sort of an extension for a natural disaster, like a hurricane or flooding, but only for those states that they're buying in or selling in. And then also we did see an extension for COVID, and that was back in 2020. That's no longer available. So sometimes you will see them, but it's very rare. So let's talk about the identification rules around a 1031 exchange. So in order to identify property, to do it the right way, the identification has to be signed by the exchanger, and it has to be in writing, okay? It also must unambiguously identify property that they want to purchase, okay? You can't say that I'm gonna go buy a new build in Miramar Lakes, or I'm gonna buy an industrial building. It has to be identified with a property address or a legal description, okay? It also must be sent in by midnight of the 45th day. I had someone call me just the other day and say that, let me go on to this next one and I'll tell you the story. But it must be given to a person that can accept it. And generally speaking, that's going to be a qualified intermediary, but it can also be the escrow agent, the title agent, or the seller, okay? But it can't be anybody who's an agent for you. So it cannot be you as a real estate agent, and it cannot be their attorney. So be aware of that. I did have a gentleman call me a couple of weeks ago, and he was like, "Oh my gosh, Trish, I forgot to send in my form, and am I disqualified? Is my exchange blown up?" And I was like, "Well, let's talk about it. Let's see what you did." And I said, "So did you go under contract prior to the midnight of the 45th day?" And he said, "Yeah, I did." And I said, "Okay. So you signed it to contract." And I said, "Did you send it to the seller?" And he said, "I did." And I said, "Then you've identified properly. Even though you didn't identify to me, you are officially identified." So he was okay. And he was like, "Oh, thank God," because I thought I was, totally messed up my exchange. Also during the 45-day period, all of those identifications can be revocable. So meaning that you can be going in and out of contract with your client during that 45-day period and not needing to tell us about it. And you can do that as many times as you want. We just want your final identification at midnight on the 45th day, okay? Now, what are we seeing in the marketplace right now? Obviously, with the market the way it is and how tight it is, this identification period is kind of wonky. People are like, well, what does identification means? Really, you're just, and we're going to talk about the different rules of how you can identify, but really you're just naming these properties. in a market that's slow, you could perhaps name properties and then go see if you can get them under contract because they're sitting out on the marketplace for 5 months or 6 months. Who knows? In this kind of market, does that happen? No. So what does identification mean? For the most part, it means you're under contract, right? So, so what does that mean? Also, when you're identifying more than one property and multiple properties, do you have to be, under contract on all those? Probably, in order to get something, I would assume. So, and also if you have closed on a property within that 45-day period, it is deemed identified and there's no formal identification that has to happen, okay? So let's talk about the identification rules because there's a couple of different rules that you can use to identify. Over on the right-hand side of the screen is simply a form that we use, pretty simple form, it's not intimidating. So generally speaking, most people will use the 3 property rule, okay? That rule says that you can identify 3 properties, okay? And it doesn't matter what the market value of those properties is, okay? You just get 3 slots. So 1, 2, 3. You can identify something that's 5 million, you can identify something that's 1 million, it doesn't matter what the price is. Now, the 200% rule is used a lot of times for people who might be selling something of greater value and they want to diversify into a lot of different properties that are less expensive, okay? So how this rule works is it says that you can identify as many properties as you want, okay? But the fair market value of all those properties added together can't exceed 200% of the fair market value of the property that you're selling, okay? So let's take an example. You're selling something for $1 million, okay? You want to go out in the marketplace and you want to identify 5 or 6 different properties. You can do that as long as all of these properties that you've identified over here and you add them up, all the market values doesn't exceed $2 million, which is 200% of the $1 million. Does that make sense? Now, there's another rule that's tricky and we don't rarely see it used, but it's called the 95% rule. This rule comes into play if for someone has identified multiple properties, they've gone over the 3 limit, and they've gone over the 200% limit, but they still want to continue to identify everything that they've put out there. You can do that, okay? However, what the rule says is that you can do it as long as you purchase 95% of the value of what you've identified. So basically everything. You have to pretty much purchase everything you've identified, and if you don't, your exchange is null and void. So it's a sticky one and can be a little tricky. Okay. So relinquished and replacement property, like I said, we must be held for investment or use in taxpayers' business. A lot of times I get the question too, what if I own a single family house? Can I buy a piece of land? Can you? Anybody know? Yes, you can. If I own an apartment complex, can I buy an office building?
Yes.
Yeah. If I own single family house, can I buy water rights? You can. So we're going to talk about some of these different things that aren't like kind. So keep in mind that what like kind means is not like kind and is condo to condo or single family to single family. What it means is real estate to real estate. Okay. That's what like kind means. So be simple. So sometimes when determining what qualifies, it's good to look at what doesn't qualify. Okay. So these are things that don't qualify. Your primary residence doesn't qualify. Now, Uncle Sam gives us this great benefit right now under the IRS tax code 121. I'm sure you guys have all heard about it. When you sell your primary residence, as long as you've lived in it for 2 of the last 5 years, when you sell it, you can exclude gain. If you're single, you can exclude $250,000 of gain. If you're married, you can exclude $500,000 of gain if you're filing jointly. Okay. Great tax benefit, but it doesn't have anything to do with 1031 exchange. Okay. Now I get calls a lot of times from folks who own primary residences who have not held their property for that 2-year time frame, so they don't qualify for the 121, and they think they can do a 1031. You cannot. You're not eligible to do a 1031 exchange on a primary residence. Okay. You also are not eligible to do 1031 exchanges under anything that you're primarily holding for sale. So a builder, for instance, okay? They are building properties and selling them. They have no intent of holding them as long-term investment purposes. They don't qualify for 1031 exchange. Same goes for flippers. So we all know a lot of people who go out and buy real estate, they fix it up, they spend a couple of months doing that, and then they sell it. Technically, they do not qualify under IRS regulations for a 1031 tax deferred exchange. Okay.
What's the minimum hold period?
That's a good question. We're going to get into that in just a minute. Huh?
This is technically, they don't qualify.
This
but
is
like-
technically, keep in mind, the rules around a 1031 exchange are rules. Okay. And, you know, and my job is to explain what those rules are. None of these come into play unless you get audited, you know, so that's the, so at the end of the day, it's like driving the speed limit. You drive, and I'm not telling you not to follow the rules. At the end of the day, what we tell you to do is talk with your tax advisor, and to consult with your tax advisor or your legal counsel, because at the end of the day, if you were to get audited, that's who's going to defend you, not me. We just hold your funds. Okay. So what I'm saying, there are many exceptions a lot of times, and there's a lot of case laws where people have challenged the rules, and the court has come back and given them case law and said, okay, you pass. We'll go through a couple of those in a
So
minute.
is there, the question was the minimum holding period?
We're going to talk about that in just a second. Okay. So also other things that are not exchangeable are stocks, bonds, or partnership interests. Okay. Those are not exchangeable anymore.
About a
So-
second or third home.
Huh? I'm going to talk about that. Yeah. So, so like kind requirements, so these are things that, so we talked about fee simple. So now these are things that you can exchange into that a lot of people don't know about. Okay. So a lease that is a 30+ year term, that's exchangeable. Okay. So you have someone selling and they want to go buy a Walgreens lease. You can exchange into that. Okay. A Delaware statutory trust. I'm going to be spending a few minutes talking about this in the next slide. Okay. A TIC interest. Does everybody know what a TIC interest is? Tenant in common. So it's where someone owns property, whether it's a residential property or it's a commercial property, and they own it as a tenant in common. So you get a percentage. So you and I own a building together. You own 50% and I own 50%. We own it as tenants in common. We don't have a partnership and we don't have an LLC or anything like that. It's just your name and my name, or it's your LLC and my LLC, but we have a divided interest and we're a tenant in common. Okay. With the TIC, each member has voting rights. Okay. So you can't do anything without me doing it and me agreeing to it. TICs were very popular back and right before the financial crisis. A lot of people were investing those. And when the financial crisis came along, they really did horribly and people lost a lot of money. And the problem was because of these voting rights. Everybody had to agree. And if there was one person, everybody else was like, hey, let's get out of this now. And if there was one person that said no, they were stuck. So that's why they kind of fell apart. Perpetual easements, doing a cell tower exchange right now. So those can be exchanged as well as mineral rights. So oil and gas and water rights can be exchanged. Okay, so just some different things out there to consider. So I want to spend a few minutes talking about the Delaware Statutory Trust. This is a fairly new, I mean, it's not totally new, but a lot of people don't know about these, and they can be a really good tool for real estate agents. And it's just another tool for your tool belt. Okay. So what these are is it's a form of a trust that's created in Delaware that allows multiple investors to own property and with professional management. Okay. So if it's structured correctly, everybody can have their own share. So how it works is you'll have a sponsor, okay, like a big sponsor, someone like Inland Securities, Cantor Fitzgerald, Pasco. These huge real estate companies that own lots of real estate will go out and take down usually very stable type assets. So maybe a large multifamily residence, Amazon distribution center, an industrial portfolio, storage portfolio, something that is generating income, and that's a stable investment. So they go down and they buy it, they take down debt on it, and then they go out and they sell fractional shares to people. Well, the IRS has allowed for someone being able to 1031 into those types of investment. So how can they help you? What is the biggest thing that you hear right now in the marketplace when you try to get somebody to go sell their property?
Where they're gonna go,
Right.
what are they gonna get?
And they have a big gain, right? I have a property, I owe a lot of money, I have a huge gain on it. And this is if it's investment property and I don't have anywhere to go. So if you were, as an agent, able to show them that there was someplace they could go and get a reasonable return, and they don't have management headaches, and they're still gonna be, it's like owning real estate, it might be something that they would consider.
So like
Okay.
they're saying, selling a house and buying like a percentage of inlands.
Yes.
Property.
Yeah. Yeah,
That's-
but again, it's investment house.
And so like the, let's say, the building that they're renters, right?
Uh-huh.
So then it's.
Yeah, I'll give you an example. So I just finished up with two. I had a woman out of Miami who was selling two retail shopping centers. Owned them for a long time. She's in her 70s, late 70s. Her business has always been real estate. Her kids don't have any interest in it. Okay. So she is selling these properties. She doesn't need the cash. And she doesn't like the stock market. So she's like, where am I going to put this money? And she doesn't want to go invest in new real estate because she doesn't want to manage it anymore, right? But she likes real estate. She gets real estate. So she's like, where am I going to go? So the DST was a perfect option for her because she knew what asset she was actually purchasing, what she was getting a piece of, because it's designated. So you know that you're buying that Amazon distribution center on that corner over there. It's not like a REIT, which is a real estate investment trust, where they take your money and it's pooled in with investors and you don't know what they're going to go buy. So it's physical property. And that's why it's identifiable with the 1031 exchange. They can be expensive. So it's important. So the other thing is these things are bought through a financial advisor. Okay. So real estate agents are like, well, why do I want to do that? Because then I don't get the other side. Well, generally speaking, if you're helping your client and you can get a listing, that's good, right? Secondly, it may be great for someone who is, maybe you found them the perfect property, but they still but they've got a little bit of a balance left over. Maybe they got a couple $100,000. Okay, especially in commercial, that they don't have anywhere to go park that money, that they could park it in a DST and they'll be earning money on it. Okay. So you want to buy it through a financial advisor. I happen to know, do you guys know John Keller? He's in Sarasota. He's with Keller Williams, but he doesn't do any real estate really. He just has his license there, but he's one of the few financial advisors out there that I've seen who knows all the product out there. And that's all he does is 1031 investments. He doesn't manage other people's money. He just puts people in these products because he knows about them. So there are good DSTs and there are bad DSTs. Okay. Generally speaking, the return on investment is probably going to be somewhere between 5 and 7%. That changes,
That's good.
Yeah, yeah, it can be. So you really need to speak with whoever's having the product that's out there, what it is. But so the advantages of it is that it can give you investment diversification because you can exchange into one of these DSTs that may have property in different states. They have 3 or 4 different properties in different states. Or you can go into one that's multifamily, one that's industrial, so investment diversification. Avoiding management requirements, that's a big one. So people who are older and coming out of these investments that they've had for a long time can now still invest in real estate, but they don't have the management. They don't have the toilets, the tenants, all that kind of yucky stuff. It's great for small balances left over. And also, it's also great for identification purposes. Because again, as we know right now, the market is really tight. So if you used one of those slots to identify a DST, and let's say, what they really wanted to do was to buy a fee simple property, but if you couldn't find one and they were really tax adverse and you identified a DST, you've saved their exchange, right? So it's a good tool. Some of the things that people don't like about them is obviously the lack of control over the asset. They have no management rights on it. Holding times, because the way this is structured, they are not allowed to refinance the property. So most commercial debt is taken down on 10-year terms. So they're going to be out of there somewhere between 5 and 7 years. Okay. Could be sooner, could be later, but generally speaking, it's going to be somewhere around 5 to 7 years. So the holding time kind of worries people sometimes. And you also have to qualify, there's qualifications for investment. So you have to be an accredited investor. Okay. All right, so let's talk about this holding period. How long do you have to hold a property in order for it to be considered under the 1031 exchange rules? Honestly, there is no bright line test. There's nowhere in the code that says it's got to be this amount of time or this amount of time. It's really based on the taxpayer's intention at the time that they're getting out of their property and buying property, okay? And many tax advisors' opinions vary. Some will say a year and a day, because you've got the two tax years. Some will say 2 years if they're conservative. Some will say less. You know, it's really and it's really how much case law that they know. And that's getting into this case law, what they know and how good they are with real estate taxes and what they say. So I'll give you an example about this intent. So let's say I go out and I'm selling a single family residence, and I decide to go buy a fourplex. Okay. My intent is to hold that property. There's 3 tenants in there, and I close on it, and I go out and rent 1 unit, and I'm just going about my business, and I'm operating it, and I'm running that property. Well, let's say you come down the road, and all of a sudden 3 months later, and I paid $500,000 for this, and you're going to offer me $2 million for it. Am I going to sell it? Probably, right? Will I be able to do another 1031 exchange? Most likely. My intent, and there's case law again that shows this, my intent was to purchase this property for long-term investment purposes. I wasn't going out there and marketing it for sale. I wasn't doing any of that stuff. Okay. So if I had a good tax attorney and a good lawyer, I would say they would be able to defend me if the IRS challenged me on that. Okay. So again, it's based on intent at the time.
So, I have a question, because like I have 2 different scenarios. Okay, my clients, they bought a house
Uh-huh.
and they have a condo. They would like to sell, but they don't want to pay taxes, right?
Uh-huh.
And someone told me that, you know, they cannot use the 1031 because when you're buying the condo, you have to like, you know, file something that this is for 1031. And someone else told me, no, just before the closing, you have to mention that you sell the condo to buy.
There's more to it than that. You have to engage with a qualified intermediary. Okay, so if they want to do a 1031, you've got to get us involved prior to the closing, because there's documents that have to be. Yeah.
Is it possible for them, because they bought, they from New Jersey?
Yeah, so well, let's talk about it.
10 years ago, and
Yeah.
right now they're like, we might sell it because, you know, it's like $300,000 more than when they bought it, but they said, you know, can we use the 1031? What's the answer?
That depends. On a couple of things. Have they been renting it out?
No, they were living there from that, like, you know.
It was a second home. So here comes your question. That's what we're going to get into this next thing about this revenue procedure 2008-16. So vacation homes are second homes. Okay. The IRS has recently made a distinction between a second home and a vacation home. Okay. Generally speaking, a second home would not be considered under the 1031 tax rules. Okay. Because it's a second home. Now, if I were their tax advisor, I'd be like, you know, how long have you owned it? Were you really using it? Was it just, I mean, were they really using it a lot? I generally see people who talk to me about second homes, and I tell them that they need to get their tax advisor's advice. Their tax advisor will say, go for it. That's what I'll tell you. Okay.
So it's not the second, it's vacation, right?
So, but now the distinction between a vacation home, okay, is generally that you're renting it out and you're not using it very much. So based on that, in 2008, they came out with this revenue procedure about vacation homes. And this is what they said, okay? It's a safe harbor rule. And they said, as long as you follow these rules, the IRS cannot challenge your 1031 exchange on vacation homes. And this is what the rules say, okay? You must own the property for at least 24 months, okay? You must rent it out at fair market value for at least 14 days per year for those 2 years. And you must limit your personal use, okay, to 14 days or 10% of the time that you've rented it out at fair market value, okay? So there's limits there. Now, this is just the safe harbor rule. Exchanges outside of these parameters often still qualify. And again, when someone talks to me about a vacation home or a second home, I'll tell them these rules and say, talk to your tax advisor. And many times the tax advisor will come back and say, yeah, go ahead.
So let's say it's not a second home, it's not a vacation home, they just bought it to hold it for 10 years just to sell it, and then it's the trick.
In case you got, yeah. you know,
And like, there were.
is it or is it in? I mean, you'll find out if you get challenged, I suppose. So, and you do on your tax returns, you do have to submit, there's some tax papers that you have to submit that you did 1031 exchange. Okay. So that, and so the same goes with the vacation home when you're purchasing one. So we get this a lot too down here in Florida, right? Well, I want to buy a rental property and then I want to turn it into my primary residence. Can I do that? Yes, you can. Okay. Under the safe harbor rules, the same thing applies. If you bought that home and you're renting it out at fair market value for 14 days for two consecutive years, and you're limiting your use to 14 days, then can you turn it into your primary residence? Yes. The other cool thing you can do at that point is once you sell it, okay, you've got to hold on to it for 5 years. Then once you sell it, you can use the 121, which allows you to exclude the gain. Okay. So there'll still be a little portion of that you will have to pay some gain on, but you'll at least exclude the majority of it. Now, same thing. Well, what if I bought a home, what if I buy a house and I rent it out full time for a year and then I decide to move into it? Is that okay? Probably, depending on what your circumstances are. So again, it all comes down if you get challenged and what your tax advisor says and why you had to move into that house and what your plan was. And there's a lot that goes into it. So again, this is why I always just say, hey, these are the rules and talk to your tax advisor. Okay.
So, for example, they can also buy land, right?
Uh-huh.
And if they start building something.
So let me hold off on that because that's an improvement exchange. You can buy land and then later build on it, but you can't come out of you cannot come out of a 1031 exchange, sell a property to go build on land you already own. Okay, you can't do that because you already own it. And use it. You can build on it. You just can't come out of a 1031 and 1031 into it.
So what about the replacement property? So you sell the house, you buy replacement property, but it's like in a really bad condition, and you wanna remodel it, and sell it later. So like a flip.
It's a flip.
So
yeah, I would tell you that's a flip.
But if they don't do it to sell it, they just bought it as a replacement property and just want to make it look better for,
Yeah, again, I would, if I were them, I would rent it out for a little while and make it look like it's an income producing property.
Like hold it for 2 years and then.
If I sold a shopping center, can I go then buy land that I want to develop?
Yeah.
This one's income producing, this one is not.
Yes, you can. Yeah, you can hold land.
What about the fair market value? Is fair market value of the rental? Is there, how to identify that? If, let's say I have a relative that I don't like too much and they're staying in my house and I charge them $100 a week in Naples Park, is that fair market value or not for rent?
No,
No.
under the rules, no, it's not. If you were to get audited, would you have a failed exchange? Maybe, because if they'd say, well, this is your sister and you're charging her $100 and you should be charging her $2,800. So it's really not considered rental property. So again, it's all about whether you get audited and how you defend yourself. Okay. So let's talk about another rule that applies. Okay. It's the same taxpayer rule. So the same taxpayer that's selling the property must be the same taxpayer that's buying the property. So generally speaking, it sounds like an easy thing, but it's one of the biggest issues that we run into as qualified intermediaries, because what happens is someone thinks they're on title or they're not on title, or there's more than one person on title. So if Bob Smith owns property and he sells property, Bob Smith can buy the property, okay? But only Bob Smith. He can't pull you into it, can't pull me into it to buy that property. Now he could buy it as a tenant in common, okay? So he could go buy a piece of property that you own and you say, okay, I'm gonna sell you 50% of my property. I could go do that. I could go buy that other 50% as a tenant in common. But you and I, if I'm selling something, you and I can't go in together. We can go buy a property, but it has to be as a tenant in common, okay? So same thing with husband and wife. The husband and wife are on the deed. Husband and wife have to still be on the deed. So what I see a lot of times is people who have owned property prior to getting married, right? So, Bob has owned a piece of property. He's been married. He just got married last year. And now he's selling that property and wants to put his wife on it. Can you put your wife on there? You probably shouldn't. because it could be perceived as a gift. And then there's what am I trying to say? An increase in basis. And yeah, a step up in basis. Okay. So best to do that after the exchange is over and then put them on. Okay. So we get into this with trust and partnerships and all these kind of things. So what gets complicated is a lot of times you'll have, especially with commercial property, you're going to have property that's held by a partnership, right? You guys own a building together. Now you go sell that building, you've developed it or whatever, you made your money, you want to go your way, he wants to go his way. What do you do? Because you're in an LLC. Can you 1031? The only way you can effectively 1031 together would be as that LLC, and you could go buy property under that LLC name. Well, if you don't want to do that and you each want to go your own way, then each of you have to drop down to tenants in common, okay, on the deed. Now, what is the timing for that? It's ambiguous. A lot of tax advisors will say you need to do a year in advance. I see it down at the closing table 9 out of 10 times. Yeah, 9 out of 10 times. Yeah, 10 times out of 10. So people are just doing it right there and dropping down into those tenants in common. Okay. So those are partnership issues. Also, if you have an individual who,
Can I ask a
Yeah.
nuanced question? So say, like, for instance, this gentleman I have in, and I don't even know how he owned that 10 flat up in Chicago. But say it's, Chicago Sunshine LLC. And so now that Chicago Sunshine LLC has to buy the replacement property here. What if you go on Sunbiz and Chicago Sunshine LLC is not available because somebody else has it? What then? Or can it be Chicago Sunshine 4 or some other name?
well, it wouldn't be available because he already owns it.
Well, in Illinois.
It would have to be in Illinois. It would still have to be in the same LLC.
Oh, so the Illinois LLC would buy it.
Yes.
Then how does that, so then would you still be subject to the income tax on the?
That's a question for a tax advisor, but yeah, you'd have to work that out. Mhm. If it's a single member LLC,
Right.
then you can switch names. Okay, so because those are disregarded for tax purposes. So if I own a building under 123 LLC, if I want to go buy new replacement property, I can go buy it under ABC LLC if I want to, because I'm a single member, because it's disregarded for tax purposes.
But if it was an Illinois LLC, you can't then create a Florida one, take it back?
Don't think so. Yeah.
That's interesting.
And so it gets really complicated, and that's why with regards to, and we have lots of legal and paralegals on staff too. So when we talk with a client, we sit down and really peel back the onion on some of these. I mean, we do $120 million transactions that are owned by a million different people or entities. And so it really comes down to who is the taxpayer. So sometimes the LLCs may not, they're owned by someone else. So who is the true taxpayer?
Right.
So you got to figure that out. And then you got to figure out how many exchanges do they need to do if they're selling multiple properties. But we're getting into a lot of kind of really hairy stuff, which honestly, you guys don't need to know. Just like I don't need to know what you know about real estate. I just need to make sure I have a good broker that knows this stuff. So that's why when you send your client to us, that's what we do, is really peel back the onion on the transaction and figure out who owns what, how is it owned, how's it going to fit, how's it work. Okay. So anyway, what I talked about is called a drop and swap. If you drop down the tenants in common, so each partner can go their own way. This is just another visual of different kinds of ways that people own relinquished properties and how they can buy it, how they can buy the replacement property. Okay. Again, it can get tricky. Okay, so as a realtor, what do you need to do in order for someone to do a 1031 exchange? You need to make sure that you have language in your contract that obligates the buyer and seller to cooperate with the 1031 exchange. I believe in the residential contracts, it's already there in the Florida residential contracts, so it should be there. Okay. Also, they must engage with a qualified intermediary prior to closing because they have documentations that they have to sign. Okay. And that has to be signed prior to the closing because it gives me the right to take those proceeds, and all the proceeds have to go to the qualified intermediary. They can't ever touch the funds. That's the whole thing. If they touch the funds, it's over. Okay. So all or part of those proceeds have to go to the qualified intermediary at the time of closing. Control of funds. Again, they have to be sent to the qualified intermediary at the time of relinquished property closing. We need to have actual or constructive receipt of those funds. And the exchanger cannot receive, pledge, borrow, or otherwise obtain the benefits of those funds during the exchange. So that's why I said if they want cash out, they need to do it up front at the time of closing, because if they call me and say I need cash out, I can't give it to them. And if I did, the exchange is over and it's blown up. There's also limitations of receiving their proceeds back. Okay, so once you've started an exchange, if you don't, I can't give you your money back. You can't just call me and say, Trish, I decided I changed my mind and I want my money back. And you're on day 2 of the exchange. Can't do that. I can give you your money back after day 46 if you haven't identified anything during the 45-day period. Once you've identified property, generally speaking, you're not going to get your money back until day 181. If everything falls apart, you're probably not going to get anything back till day 181. And if you have anything left over, you're probably not going to get anything back till day 181. That has nothing to do with our company. It's the IRS regulations. Okay. So, and keep in mind that once people have identified stuff, you can't go back after the 45 days. If everything falls apart, you've identified 3 properties and they all fall apart after the 45 days and you can't close on any of them. Can you go back and re-identify? No. You have a failed exchange and you're responsible for the taxes. Okay. Before I get into my last part, I just want to tell you guys about a couple of different things that I'm seeing right now. So I'm seeing a lot of reverse exchanges. I could do a whole class on reverse exchanges, but I don't need to, because you just need to know what they are and that they exist and to call Trish. Okay. if you have a client who wants to do it. So reverse exchange is where someone will buy the replacement property prior to selling their relinquished property. They have to have a qualified intermediary involved though, because what happens is we create what's called an EAT, an exchange accommodator's title holder. So it's really an LLC, okay? The exchanger also needs to have the money to buy that property, because we don't lend it to them and we don't go buy the property. We just hold title, okay? So at the end of the day, when that purchase is done, First American Exchange is holding title under a LLC name for them, okay? So they have to have the money up front to purchase that property, or have a lender. Now, we can do lenders and we have lenders who do them, but we have to have non-recourse financing. And a lot of people won't do that. So it's easier if it's, especially on a residential one, it's a cash deal. Commercial deals are a little bit different. A lot of times we can work with the lenders. They're a little bit more sophisticated. They understand these things as far as the transaction goes. There are insurance requirements as well. And also a phase 1, if it's anything over a fourplex, has to be submitted to us. And it's expensive. It's not cheap, but it can be done. So as a matter of course of business and commercial property, we see a lot of reverses done all the time, because you have somebody who may be moving out of a warehouse, moving into a new one. Are they gonna close up shop and hope they find something in 45 days? No, they're gonna block it in. So it's just a course of business for them, because that 45-day window is a long time. And same thing with people with houses too. I mean, if they've got that much gain, they're like, a typical residential transaction costs 75. A typical commercial transaction is probably going to be around 15, depending on the price. But is $7,500 worth it when they're saving $200,000 in taxes? Probably so. Is it worth locking that up and having the ability to do that? There's also another thing called the improvement exchange. So, and this you can do, like if you want to go buy land and then you want to build on it. Okay. Again, the issue with it right now is timing, because all those improvements have to be completed within that 180-day time frame. So that can be a problem. It doesn't mean it has to close, but it has to be completed. We have to have spent the money. So you've really got to have your ducks in a row. I mean, you've got to have your permitting and everything done in order to move and get that done. And you can't just go out and buy the wood and all the materials. It has to be, as we pay out, it has to be completed.
That would never happen.
No, it doesn't happen anymore. Just, yeah, they're kind of non-existent right now because people can't get them done.
No, one of the conditions yesterday, it's about 36 months.
Yeah.
From the time you get some approved by the county.
Yeah,
So
people going, say, I want to do some improvement station. I'm like, honey, no, you don't. Just pay expenses. And especially if they just want to do some improvements, like $20,000 or $30,000. I'm like, just pay the taxes and expense it, because it's just going to be a hassle for you. Super tax break. I want to tell you guys about that really quick too. It's not part of my presentation, but the super tax break is where you own a primary residence and you want to turn it into a rental property. Okay. Why would you want to do that? Let's take an example. You bought a primary residence 25 years ago for $100,000. Okay. You're selling it for $1 million. You've got $900,000 of gain. let's assume that you're married, okay? You're married, you're filing jointly. So $500,000 of that you can exclude doing a 121, right? But you still got $400,000 of gain that you're going to pay taxes on. That's a lot of money. So if you didn't want to do that, you could rent your house out for a year and a day, year and a half. And then when you go to sell it, because you've lived in it 2 of the last 5 years, you could, when you sell it, you can use the 121 for the 500, and you could do a 1031 on the 400 and go do it, and then go buy investment property on the 400,000. Pretty cool.
What would the value of the 1031 property have to be in that example?
400,000.
Oh, that's it.
Yeah. It'd be a partial exchange.
Okay.
Because you've already
Or greater.
500, yeah. 400, yeah. Okay, so let's get into my little sales pitch. Why First American Exchange? So the biggest thing you want to know when you're working with a qualified intermediary, and the things that you need to ask, is how are they holding your funds? Okay, I've got your money. Okay, so who are we? What do we do? How do we do it? How do we hold your funds? So at First American, we hold everybody's proceeds in a single account. It's under your name and your taxpayer for your benefit. Okay, it's not commingled with anyone else's. It's an FDIC insured banks. We are heavily bonded by a reputable insurance company, and we have $25 million of bonds. We're insured and bonded. And we have qualified intermediary status, which is offered by the Federation of Exchange Accommodators. Okay. Not to say that local people aren't good. I'm not saying that at all. Or an attorney often attorneys will say, hey, I'll do it. There is not legislation, there's case law out there that has nullified exchanges with an attorney being the qualified intermediary. Why? Because they were an agent. Okay, because they also looked at as an agent. So be careful. Because a lot of times the local intermediaries might have one bank account where they put everything into it. Okay, and there's nothing illegal about it. And there's nothing illegal about you deciding you want to be a qualified intermediary and set up shop tomorrow and spending the money however you want to spend it. But that's what happened in the financial crisis. People had these qualified intermediaries. They were taking everybody's money. They were spending it on investments, on their own operating expenses, robbing Peter to pay Paul. And when the market failed and they went out of business, not only did the taxpayer lose their money, but guess what? They had to pay their taxes on the money that they lost. Didn't matter that they didn't have the money, they still had to pay taxes on it. So super important to know who you're working with. And as I said, as a local, and some local companies don't have those single accounts. So even if they have the best of intentions, if for some reason they get sued, what happens to that bank account? It gets shut down, right? Is your money in there? And your money in there? So what happens to you? You're stuck. So important. So First American, we're a national company. We have offices all over the United States. I service the Florida area. And I would love to be a resource for you guys with regards to your 1031 exchanges. I would like to get everybody's email addresses. I think I can get that from up front because I've got some flyers that are great. I'm going to send you that are great to just keep on hand. It's called Just the Basics. So if you have a client who says, I want to do an exchange, you can say, here, read this and call Trish. So with that, anybody have any questions with regards to the 1031? I'm going to see how to do this. Let's see. Anybody online? Is there one chat?
Yes.
Oh, the sound is real bad for the Zoom. Were you guys able to hear me?
Yes.
Oh, good. Okay. Do y'all have any questions?
No, not at this time.
Okay. Anybody else? Any particular situations? Yeah, go ahead.
You don't have to spend all the money.
You don't have to spend all the money, but what you don't spend will be taxed.
Okay.
So you don't have to, but
Can
there
I
will
take
be.
them before the exchange, right? Or I can also wait.
You can wait till after, yes, you can take it before, or you can wait till, you can wait till it's over, and then whatever's left over, you'll just get back.
I have a quick question. Is this applicable to a builder as well? You might have mentioned that, but I missed it. So someone who builds homes and sells them.
Yeah, no, it would not be, because they're owning property that is primarily for sale. So not for long-term investment purposes. So that would generally not fall under the 1031 exchange guidelines.
Thank you.
Sure. Anything else?
We have a very specific use case for potential client slash landlord. that
Yeah.
I live in this house, like I said, he has 3 houses, 2 here in Florida, 1 in Tennessee. I live in one of them right now as a renter. He's going to sell it at sometime in the next couple months here. I want to propose to him the possibility of being able to do this. You mentioned that if it is a rental property, you could sell it.
Yeah, and you can sell multiple properties too in one exchange if you want.
Yeah, he has a second home that he may just vacate for altogether. And he mentioned about building in Tennessee at some point, a second home, which he would move into and then gift or sell the other house to his kids. I don't know how all that plays out.
There's some interesting rules around that, and he and I would probably need to have a
Yeah,
conversation. So he could buy the land, and if he wasn't going to build on it for a little while, I think that would be exchangeable for him because he's holding it for a couple of years, probably before he has to build. And then with regard to selling, if you want to sell something to a related party, there's some related party issues there. So generally speaking, if you're selling to a related party, the IRS doesn't like that.
Yeah, no.
They look at it as basis shifting.
Yeah, no, you get that.
Yeah.
That part.
Yeah, sometimes there's ways around it.
But the names on the second home, I wasn't sure if it would qualify as.
I'd have to pick through it a little bit further, but I'd be happy to have a conversation with him if
Yeah.
he's interested in doing it.
Sure.
Wouldn't doing multiple sales be a really bad idea?
Multiple sales? No, you mean putting them in one exchange?
Yeah, I mean, if it's one buyer for every.
Are you guys using that napkin? I've got a runny nose. It's so
No,
cold in
no.
here.
I mean, if it's one buyer for everything, then there's no issue. But if you've got
Well,
five-
the issue with multiple properties that you're selling is, do you put them under one exchange? It's cheaper to put them under one exchange because we charge $1,500 for a one-to-one exchange. So selling one property and buying one property, and then we charge an additional $250 per property after that. They have to be all the same taxpayer. If they're different taxpayers, I have to set up different exchanges. So, but the problem is the timeline will follow the closing of the first sale, okay? So if I'm selling 3 properties and I close on this one on April 15th, my 45 days and my 180 days start on April 16th, okay? So if you're pretty sure that these are all gonna sell quickly, you're probably okay, but it does narrow that time frame down. Yeah, it's a little scary.
Is sorry. Was that like a Grant Cardone, the Delaware Cross scenario you were talking about?
Grant Cardone.
He's one of the TV guys or radio guys that buys all these apartment complexes and then. Yeah.
Oh, I don't know, but see, here's the thing with DST is why you want to make sure you have a good financial advisor, because there's a ton of them out there. You and I can go buy a property and put it into a DST and sell it as a DST. Doesn't mean it's a good investment for somebody. That's why, when I recommend somebody, most people go into the ones that are owned by Inland and Black Creek and Cantor Fitzgerald. I mean, these are huge real estate companies that they've bought stable investment. They're not risky. I mean, they can be if that's what you're looking for, but most people at that point who go into a DST are looking for stable mailbox money. They just want someone to park their money. They don't want management headaches. They don't want to be in the market. They don't want to be in the stock market. They're like, I don't need the money. What am I going to do with it? I just want to get some reasonable return.
All of that, he just wants probably to evade paying taxes on those gains.
Yeah. So that DST might be a good option for him.
He bought it for $1 million, it's probably worth almost $2 million, and then I don't know what the property is worth, but he's gonna have some pretty large gains that.
Yeah, that could be. It might be a great opportunity for him. You had a question?
Yes, you mentioned that we need to put, like, as a realtor, we need to put the language into the contract before the property is sold. If there is no such language, does it cancel the sale or?
No, it doesn't. No, it doesn't. It just, what you wanted in there to obligate each of them to participate with it.
What would be their role?
The buyer,
Yeah.
there isn't any role unless you might have to change a closing date to get paperwork done, or, you just want them to be reasonable and logical, and yeah. But there isn't any role. I know a lot of people are like, well, my buyer's not gonna like that. It has nothing to do with the buyer. It doesn't hurt them at all. Sure. Anybody else? Will you please leave your contact information and any handouts that you might have? I am a Zoom participant, would welcome any information you can provide. Yes, I'm going to email you all information. And so I'm going to send you my email address as well. Maybe I know how to do that. Just email me and I will send you information. But I should be able to get a list of everybody that's here, and I'll forward those two things that are great to keep on file.
Yeah.
Well, thanks, guys. I really appreciate it. Yeah, sure.
Okay, one more question.
Yeah.
If I identify properties before I sell and I go under contract, those properties.
That's a great question. You can do that. That's a really great question. A lot of people think that they cannot go under contract on their replacement property until they've closed on their relinquished property. Not true. You can go under contract. We don't care. You just got to make sure the closing date is set out, right, from the closing date of the relinquished property. It's got to be a few days after. That's a great question.
It could be a contingency on the 1031 exchange.
Yeah. Yeah. Some other market that will take that these days, but you never know. Yeah. Yeah, sure. Well, I enjoyed it. I enjoyed meeting you all and
Thank you.
hope you found it. I've got a card for you too. If you came in late and you didn't get a card, I've got cards over here. Okay. Oh, yeah, it was on the calendar at 12:30 and then we talked and it went to 12 and